Look at this trajectory. This line tracks the economic growth required for India to reach a $7 trillion GDP by 2030, and this specific bracket highlights the $2.2 trillion that must be invested exclusively in infrastructure to make that target mathematically possible. Right now, the government is carrying the vast majority of this financial burden by aggressively expanding its public capital expenditure. You can see the scale of this intervention on the updated chart. Federal capital expenditure has grown exponentially, climbing from 2 lakh crore rupees in the 2015 fiscal year to a projected 12.2 lakh crore for the 2026-2027 budget. That spending has yielded tangible physical results. Access-controlled expressways have expanded from less than 100 kilometers to over 5,000 kilometers, and the broad-gauge railway network is now entirely electrified. But relying strictly on the union budget to bridge the remaining trillion-dollar shortfall is mathematically impossible. The state simply cannot tax or borrow enough to cover the remaining distance alone. A $7 trillion economy rests on a new mechanism for capital formulation that draws in money from outside the public treasury, moving past the limits of government spending. That outside money has to come from the private sector, which currently presents a massive capital void, ranging from $103 billion to $324 billion. This pie chart illustrates the total available pool of domestic institutional capital. Notice this isolated sliver. Massive domestic insurance and pension funds allocate only about 6% of their total capital to Indian infrastructure. The reason for this low participation is strict risk aversion. Institutional investors view early-stage Indian infrastructure projects as highly volatile, carrying extreme default and execution risks. Because private funds refuse to take on these early-stage risks, the government is forced to completely overhaul how it interfaces with private capital markets. We are watching a transition away from traditional bank loans and budget reliance, moving toward a complex ecosystem of institutional de-risking and asset monetization. India's infrastructure deficit has become a high-level calculation and financial engineering. Historically, India relied on traditional commercial banking to fund large-scale construction and industrial projects. That model contains a fatal structural flaw known as the asset-liability mismatch, a situation where a bank's short-term debts do not align with its long-term investments. Let's look at the liability side of this mismatch on this balance scale. The left side represents a commercial bank's liabilities, short-term retail deposits that typically mature in just 1 to 5 years. The right side represents the assets. When banks fund greenfield infrastructure, completely new projects built from scratch, they are locking that money into assets that take 20 to 30 years to generate a profit. The scale breaks. Tying up 1-year deposits in 3-decade concrete projects creates severe liquidity crises. When depositors want their money back before the toll road is finished, banks are left with non-performing assets or loans that are in default. Banks attempting to fund this growth with short-term deposits face chronic liquidity stress and a rising volume of non-performing assets. To bypass the limits of commercial banking, the government engineered specialized development finance institutions, or DFIs. These are specialized entities created specifically to provide high-risk capital for national economic development. The premier institutional anchor in this new system is NABFID, the National Bank for Financing Infrastructure and Development, designed entirely to provide long-term, non-recourse finance. Unlike a commercial bank, NABFID does not rely on retail deposits. It raises long-term capital directly from debt markets, perfectly matching the 30-year duration required by infrastructure projects. These new institutions use a critical market mechanism called partial credit enhancement, or PCE. PCE is a financial guarantee where an institution promises to cover a portion of a project's debt if it defaults. By wrapping a project in this guarantee, PCE artificially uplifts the project's bond ratings. This legal upgrade allows highly cautious, heavily regulated pension and insurance funds to finally invest their capital. The government also deployed the National Investment and Infrastructure Fund, or NIIF. NIIF operates with a unique mandate, managing $4.9 billion by co-investing directly alongside global sovereign wealth funds. NABFID and NIIF operate as highly specialized financial bridges, safely channeling massive reserves of global and domestic institutional capital directly into Indian megaprojects. Raising capital is only half the equation. The government also adopted a macroeconomic strategy to shift its existing infrastructure from an asset-heavy to an asset-light balance sheet. This strategy relies entirely on brownfield assets, completed, operational projects generating steady revenue like this active multi-lane toll road. To mobilize these assets, the government utilizes infrastructure investment trusts, known as INVITs. These are mutual fund-like vehicles that pool income-generating infrastructure assets together. INVITs provide developers with immediate liquidity from retail investors and global markets who want a steady yield. The scale of this monetization is massive. To date, INVITs have successfully released over 1.5 lakh crore rupees in capital. This creates a continuous recycling loop. Liquidating safe, operational brownfield assets generates the massive upfront capital required to build the next generation of high-risk greenfield projects. Raising capital at the federal level means nothing if that capital cannot be physically deployed on the ground. Across the Indian subcontinent, the single largest legal bottleneck causing project delays is land acquisition. The data is clear. This chart maps the delays reviewed under the government's Pragati tracking platform. The dominant section here shows that nearly 35% of all unresolved project hurdles are directly tied to land disputes and title issues. The secondary friction point exists in urban financing. The municipal bond market is extremely fragile, leaving urban local bodies entirely dependent on erratic state and central government grants to fund local projects. Solving the macroeconomic financing framework in New Delhi is useless if localized land disputes and municipal funding failures trap the capital before a single shovel hits the dirt. To secure those missing billions from the private sector, the government must actively neutralize the early-stage execution risks that investors fear. Global investment funds operate on strict risk parameters. They prefer buying into finished operational projects and avoid the chaotic, unpredictable risks of early-stage construction. To address this, the 2026-2027 Union Budget introduced a highly specific financial tool, the Infrastructure Risk Guarantee Fund. Looking at this project timeline, the fund works by absorbing the highest-stakes construction phase risks. It provides direct, partial guarantees to lenders, acting as a shield that forces the risk peak down to a tolerable baseline. This creates an economic effect known as crowding in. A small government guarantee acts as a catalyst to draw in massive volumes of private developer investment. If the government does not absorb this early-stage construction risk, the private sector will simply refuse to participate in building India's greenfield infrastructure. This financial discipline is now moving down to the municipal level, specifically targeting the rapid infrastructure growth expected in Tier 2 and Tier 3 cities. Historically, local urban bodies relied entirely on unconditional central grants. This destroyed any incentive for financial self-sufficiency or local revenue generation. The government replaced this with the City Economic Regions, or CERs, initiative, operating on an aggressive challenge mode framework. The mechanics are strict. To access their 5,000 crore rupee allocations, cities must successfully implement rigorous property tax reforms and digital governance protocols. This policy forces a permanent structural transition from passive grant reception to active competitive financial management at the municipal level. Reaching a $7 trillion GDP relies on rigorous financial engineering, institutional de-risking, and sophisticated asset monetization. Without the finance, the concrete never gets poured.